Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Welcome back, everyone. I am your host, Scott Henderson, and my co-host is Dr. J. This week, we are doing things a little bit different. I personally am in a little bit of a conundrum. And we figured it would be beneficial for you as the audience to kind of listen into some of the behind-the-scenes conversations that Jason and I have. So before we jump right into it, I'll give you a little bit of background. I am in the middle of about 3 generations. I've got myself and my wife. I've got my wife's parents, my parents, which is a second generation. And then I also have my firstborn, who is now about 8 months old. So that just begs the question, first, let me think about this. Where should we go first, Jason? If we're trying to do the infinite banking concept, who do we max out first? Is it best to focus on Snugs, who is my child? Is it best to focus on the grandparents? Or do I max myself out? What are your thoughts there?
One of the things we have to realize when we're doing the infinite banking concept is you can do the infinite banking concept basically from wherever. The best platform or the best tool to put it into place is a dividend paying whole life insurance policy. Now, having said that, there is a death benefit associated with that contract. And let's not diminish the value of that death benefit. That must come into play when we're considering on whom we are going to have the contract. So in your situation, the best and first person that you need to insure is yourself and get as much as you can. Since you are the primary breadwinner in your family, that's who you insure first. Then you insure the spouse, right? And after that, we can have further discussion. So I want to be clear here that the death benefit really is important. And it's impossible to leave someone rich with life insurance. Life insurance, like all other types of insurance, is simply to make whole. You're driving down the road, some idiot pulls out in front of you, crashes into you, it's completely their fault, and you have insurance and they have insurance. Well, the only thing the insurance company is going to do is to replace what was lost. Now, if you're driving a $40,000 car, that's what they're going to replace. $40,000 car. They're not going to put you in a Porsche because you got in an accident. They're simply going to replace what was lost. When you have, home insurance and there's a big hailstorm or windstorm comes through and it blows off parts of your roof, they're not going to put tile roof on there when you have shingles. They're going to put back what was there. The same thing here with life insurance. You're only able to qualify for enough that would replace your income, and we're talking as you as the breadwinner, your income until age 65, whatever that would be. So you get a death benefit. Let's say you're 30 years old and you pass away. There would be enough money for it to grow at, say, 3 or 4, a very conservative number, and the family to have your annual income at when you passed away until age 65. Now, the family would have to be smart, you know, save part of that, what they're taking out right there to live on, so they can have money after 65 for the fact that Social Security is not going to cover it all. So let's be clear, that's where we start. We're thinking that way. Okay, well, we're going to build on this platform of a whole life insurance policy. That's the place we insure first, is you. Hopefully that answers your question.
So we start with me and my wife, and for the audience, just to recap, like an infinite banking relationship with an insurance policy is designed to be a bank for you. And so I would imagine that's tying into some of your advice. I mean, the first thing that you said was, yes, there's a death benefit, and that is to help in the event that me, if I were to pass away, being the main breadwinner, that's Snugs and my wife wouldn't be scrambling to find a way to make ends meet. Correct?
Correct.
And then if I stay alive, that policy just should become a place to store cash. So that makes a lot of sense. Now, here comes a little bit more of a difficult question. Once we're tapped out with either myself or my wife, do we go to the next generation or do we go to the prior generation?
Well, that's a real conundrum, and it's kind of situationally based. For the fact the longer a policy is in force, the better it is. Some people could sort of think of it this way: is when you're buying a house and you have a mortgage, that very first payment is, 85, 95, 85 to 90% interest. So let's say there's $1,000 is your mortgage payment, right? $950 is going to interest, and only $50 is going to principal. However, when you fast forward, say 10, 15, 20 years, and you make that still same $1,000, maybe it's only $500 that's going to interest and 950 that's going to principal. So it's building up equity in the house faster as it's longer it is, right? Similar thing happens with whole life insurance. The longer it's in force, that equity portion or the cash value is building faster and faster and faster. It's not a straight line, right? It starts to J curve, if you will, like you see some financial curves when you're talking about how money grows. So, in thinking of that, we'll say, well, then I want to get it on my child. Well, to some degree, you're limited on how much you can get on your child. It's limited to how much I have on you and your spouse. Most of the time, it's a percentage of the least amount on the spouse. Now, on a flip side, and I talk about this a lot in my recent book, Master Your Millions, the importance of insuring the generation before you. Because really, to get to wealth, there's really three things you've got to be thinking about, three lever points, if you will. What one that most everybody knows about is OPM, other people's money. You need to leverage other people's money to enhance your rate of return, whether that's in real estate, a business, I don't care what it is. Most people know about that. You say OPM, they know what's that. Well, what about OPK? Well, what's that? That's other people's knowledge. That's why mentors, team members, and different things become very valuable to you to avoid pitfalls, be able to do things the smartest possible way so you don't lose money along the way. But then there's another thing is OPT, and that's other people's time. Well, how do you leverage other people's time? Some of that is saying, okay, I'm going to get an employee and I'm going to leverage them, and I can make more from their work than I'm going to pay them, so I'm leveraged there. But one thing that people don't think about is a life insurance contract on someone is actually borrowing their time. You're borrowing their life. So statistically speaking, Scott, I'm going to die before you. I hate to say that, yet that's the reality. Um, and so in the event you were to get a policy on me, you're leveraging today's dollars or yeah, today's dimes, if you will, for future dollars, income tax free dollars. And good chances that I will pass away when you're starting to hit the 70 mark. And that's when will need a lot of money to sort of step back and to slow down and do whatever it is that we want to do. And that's a thing that a lot of people in the life insurance industry, and particularly in infinite banking too, is that they don't recognize, wait a second, there's a leverage play here. I can still have the cash value and I can use it to invest and do whatever it is I need to finance things in my life when I have a policy on my parents. But there's that kicker in the end is that whole life is the death benefit that comes income tax free to you. So I'm of the opinion that you would probably want to do uh, a few policies on your parents or in-laws and then start to get something on your child. You don't want to go, overboard on your in-laws because it is a leverage play. It's a longer term thing. That death benefit's going to come down the road. Yet the same thing with your child. You don't want to wait till they're 10 to start it because then when they get to college, it was only been in force 10 years versus 20 years if you started it when they were real young.
Okay. So here's another question for you then. I've got 6 siblings and I'm the oldest of 6, and I make a lot more than Brixon, who is 15 right now. If I were to take out a policy, say on you and mom, can I max it out and Brixton can then also get a policy, or is there a set amount that us six can share?
Well, the human life value, and I hate that even term to attempt to put a value, a dollar value on someone's life. Yet that's a term that we use in the life insurance industry, is based upon your income and or your net worth and your age. So let's say you were able to get a life insurance policy on for the total amount of my value, right? My human life value. And then Brixton came along, would she be able to get a policy as well? No, she wouldn't. However, there's other ways to look at it. There's also, say, for the fact that you and I are business partners in a couple of different ventures, I could be a key man policy, and you could get a key man policy on me that would not step on the toes of your siblings. Or, as time goes on, you could say, well, get to your siblings, say, okay, everybody's going to put in a fixed amount of money and we're going to max that out. I do have a colleague who his mother-in-law, had grown up fairly not very well to do, financially, and her husband had passed away, and he had this very idea. He says he got the siblings together and he said, "Look, we're all going to get together and we're going to buy a life insurance on grandma." That's what they call her, right? And he went to her and said, "Look, if we do this, then when you pass away, everybody's going to get an income tax-free windfall of money." Well, she was all over it. I mean, I will basically be leaving an inheritance to my kids. He says, yes, essentially that. You'll be leaving an inheritance to your kids. And she really liked that for the fact that she didn't have anything to leave to her kids, a few knickknacks and memories and stuff. And so they did, they got together and people could put in different amounts for the fact, like you mentioned a minute ago, people made different amounts. They said, well, I can, do $200 a month. Well, I can do 1,000, well, whatever it was, right? But they kept track of that. The family got together. They bought the biggest policy they could on grandma. And unfortunately, it worked out to be a phenomenal idea. Now, I say unfortunate for the fact that after they got the insurance policy, she didn't last very long. I think she only lasted another 3 or 4 years. They would happily give all that money back to keep her, longer. So that's the unfortunate part. The fortunate part is when you look at the rate of return on the money that they invested for the premiums, it was way high, like 30, 40% per year on the money they're putting there, right? Just an example. I mean, that's kind of extreme example where they only lasted a short time, but that is something that it really is a way of building intergenerational wealth by getting policies in force. So someone like you and I that's come along and we find out about it and we understand the value of a dividend paying whole life insurance from a long-term point of view, there's nothing better. And our generation before us didn't know that, then we need to insure them. But ongoing, sooner or later, you'll become a grandpa and you should have all the policies on you, have policies on your kids, and the grandkids come, you start getting policies on them.
Okay, so continuing that train of thought, then you've got you made a decision a long time ago to try to make it I think it was equal or fair between me and my siblings, right? You did a X amount on me, a little bit less on Carter because he was younger, and then you kind of went back and redid it. Looking back, how should you have done it? Or how would you have done it differently? And maybe you
So
can
one of the
help
things I was
clarify my question because there's like specific dollar amounts and I don't want to get too personal here.
right. So one of the things I was looking at, could I have the same cash value for everyone at a certain point in time, like say at year when they turn 20 or something, when they go to college or something, right? And so I figured, well, I have less time to accumulate that amount of money with the oldest than I do with the next one. And it was just a crash and burn. I learned from that, and now it's just simply you do the equal amount on each person. And in the event that you come along, say maybe the fifth or sixth person, you're unable to do the same amount you're putting on the first, well, then you wait a little while and you do the same. when people really understand what this is all about and what it can do for your family, both during your lifetime and your kids' lifetimes, your grandkids' lifetimes. I mean, I gave your daughter, let's assume that she becomes the only one, or her and her siblings, I gave them a large sum of money, and it came into existence about 16 years ago when I got the policy that I own on you, right? For the fact that I'm going to be able to use it during my lifetime, but it'll be passed to you. But then when you pass, there's going to be a pretty significant death benefit there that's going to go to my grandchildren, right? And that all came into existence. It was a gift that was created quite some time ago.
Okay, so just to kind of recap, make sure I understand, you would do it just equal, whatever the dollar amount is. So,
Premium, yeah.
all right, let's say I'm fortunate enough and the business is producing enough. I'm able to do the full amount on me, full amount on my wife, grandparents, and now we're on to Snugs. Would you max her out? Or would you just do a set amount?
I think I'd do a comfortable. One of the things I see people that get excited about the infinite banking concept is sometimes they get, it's kind of like going into an all you can eat restaurant and there's steak and lobster and shrimp and everything, and they pile a big plate, right? And then they're unable to finish it all. Um, you want to be able to, the premiums need to be, stretch you, but you don't want it to be so bad that you can only keep it going for 4 or 5 years. There's a possibility of losing money with a dividend paying whole life insurance policy, and that's in the early years. If you can keep it going, sustain it for a long time period of time, there is nothing on the planet that's a better financial product. There isn't. I can prove it by math. I can prove it by logic, and every way. I mean, I'm willing to talk to anybody about it. So I'm not sure that I would max her out. Um, unless you really feel like that I could continue that with, 4 or 5 other kids. If that being the case, then you get it going. You can always make modifications. It's one of the things we're after, initially is the cash value. That's what we're using, right? That's the living benefit. That's what makes it life insurance. Most of what people know out there is not life insurance, it's death insurance, right? Term insurance is death insurance for the fact that you have to be indemnified, right? Or the loss has to be replaced. Someone has to die with term insurance in order for there to be any benefit whatsoever. Yet the industry knew a long time ago no one wants to talk about death insurance. So it really is a misnomer to call term insurance and even universal life insurance life insurance. It's death insurance. Whole life insurance, dividend paying whole life insurance truly is life insurance for the fact you have lots of living benefits. And that main living benefit is the use and control of the cash value.
I see. So going off of that, in the book, Becoming Your Own Banker, Nelson Nash specifically says you want to get to the point where what you make equals your premium. And you seem to have contradicted that. How do you mash those two ideas, or do they mash, and do you actually contradict him there?
Yeah, I'm not sure I follow you that I contradicted that.
So you said that paying the premium should be comfortable, right? Instead of loading up your potato with mashed potatoes and lobster and everything else and doing as much as you possibly can. So I mean, you're talking about doing it for the longevity. That being said, though, is you want to do as much as you possibly can. And I think that's what Nelson Nash is referring to, is like you want every penny that you make to go in there and then pull out what you live on eventually,
Absolutely.
correct?
I mean, yeah, you want to do as much as you can, as fast as you can, for as long as you can. Now, you might say, you know what, I'm going to fund one on the first child at this amount, and it's the max that you can do right now, but then I'll only fund it for 10 years. And then I can handle the next one or the next one. My only caution there is attempting to go too big too fast. Even Nelson said in his book, and if you talk to him, if you had talked to him, he would say that it's going to take a while to get to that point to where your premium equals your income.
So then how do you scale that? Like if you had someone walk in, they make a healthy amount of money. What would you say? 10%, 20%?
I would say, you know, the richest man in Babylon says that a portion of everything you make is yours to keep. And I add the word forever. I tell everybody a portion of everything you make is yours to keep forever. In other words, it's got to go from generation to generation. Now, having said that, I think a minimum of 10% of your gross income needs to be your premium. Ideally, I think it'd be closer to 20, 30% of your gross income would be premium. And that's going to sting maybe early on. But as you get into it and going, I mean, maybe it's a tiered thing. You start here, then you're making more. So you get another policy and you get another policy. And the cumulative of that still is the, 20, 30%. That's where you need to be.
I see. Okay. And so when people go for me, for example, I'm probably in that 30% mark at the moment, although my income is growing exponentially at the moment too. Would you continue to just do that? Like, I mean, that's another thing I've been meaning to talk to you about is like, should I go and get another one right now? Should I go get another policy and start that? Because I know in year 8, 9, 10, 15 that I'm going to wish I had more, but it also takes away a little bit from, I mean, that's a lot of debt to owe to yourself. I mean, you've got an idea on how much I do in premiums a year. What would be your suggestion there?
Again, as much as you can, as fast as you can, for as long as you can. And when that's well designed, your premiums are flexible, right? There's the have to premium and the get to premium. The get to premium is really the secret sauce. It's a rider that gets you to cash immediately. And you're not required to do that premium every year. You can say, you don't even have to say anything. It's just don't do that premium that year. And so you have that flexibility. Um, Now, on the other side, the IRS kind of limits it or throttles it down how much you can put in based upon the have to premium. And sometimes when it's designed in such a way, well, that have to the total can only go on for 5 or 6 years, right? And so then, well, I can do more now. So should you do more? Yes, you should. When you, like I said, when you really go through the math and understand what's doing and how it's doing and what you can do with it, then you should do as much as you can. And I wouldn't say that's okay, do as much as you can and then leverage it 100%. Leverage your cash values 100%. You need to start working that up. So let's say your cash value, I'm only going to leverage 70% of it. So I'm keeping 30 there. Right. And then go on. So let's say you have a $10,000 cash value, you're only going to borrow up to 7,000 and keep 3,000 there because that's your emergency fund, that's your fallback position in case there's a recession, all kinds of things, right? So I wouldn't be saying that have a $10,000 cash value and 100% leverage it, because you're right. If you build it up, you have more and more loan. Well, then your a lot of your income is being eaten up and repaying the loans on the policies. That's early on. Later on, the interest on the policy loan becomes a smaller portion of what's actually going on.
I gotcha. So what did you do? Because you made a mistake at the beginning of doing one too big. And looking back at that, was it just because of you didn't understand how your income comes in? It was just a bad year. What happened?
Life happens. That's the bottom line. There's always that, and I did not have it to where there was really good flexibility, right? And so that because of that mistake or that oops, 2009 was a tough year for a lot of people. So was 2001. So I mean, you hit that point, and if you're unable to sustain your premiums, you can have trouble. And so I'm very careful that when I talk to people, say, we want to be able to make sure that we can do this. That's another reason why you should have a portion of your cash value never loaned out for the fact, let's say you go a year or two without income, you still have some cash value there that you could take a loan against and pay your have to premium. And I have a client that he was a physical therapist, we showed him how to do it, was excited about everything. He got into I don't know how many years into it, and his group or what office or whatever you call it got sold to a different owners, and he simply did not get along with them. And it got to the point where he just walked out. He was done. I'm not going to do this, right? I'm not going to put myself through this. Well, all of a sudden he has a mortgage and he had this and that. And he, had followed good advice and still had some reserves of cash values that he hadn't loaned against, for other things. He was able to take loans against his policies to make his mortgage payment. I think he was unemployed for like 6 months and didn't have a problem. I mean, had it any other situation, he would have had his house foreclosed on, right? Yet his cash values were compounding its gross amount. So when he pays that back, it's as though the money never left the account. And so he's still on track to have a good amount in passive income time, or some people call that retirement. I don't like that word.
You see, are there while we're on this topic too, are there certain principles or rules that people can follow? Because I went through 2008, 2009. I was in high school playing baseball. Honestly, I don't remember a whole lot about it. I looking back, I remember very little. And now going through what we're going through in this turbulent time, it's hard to plan for the future. So are there some, I mean, you've suggested an emergency fund, although what kind of rules do you put to that emergency fund? 9 months, 12 months, 2 years of just everything whittled down to the bone?
Well, the average length of it, I'm not positive what the average length of the recession is, but I think it's 18 months, something around there. And so I think an emergency fund should be close to that, or more, 2 to 3 years of just bare bones expenses. Should be something that you have access to it. There's people that talk a lot about money rules, what you should have for your own. And if you want to look at an earlier episode, we talked to Randy Tate a little bit about this, but he has the idea that 75 to 80% of your wealth needs to be in solid liquid situations. And the best thing that you can do as a foundation of your money, your financial fortress, is dividend paying whole life insurance. It's liquid, you can get to it, you're in complete control of it. When you take a loan against your policy, they don't ask, are you employed? They don't ask, can you pay it back? Well, you have total control. Same thing back to my physical therapist friend. They didn't ask him, hey, can you pay this back? He was taking loans on a monthly basis, making his mortgage and taking care of expenses as he was trying to get things back on his feet. Got back on his feet, and he went to paying that off. It was great.
Awesome. Well, trying to think, is there anything else about are there any other rules or certain things that would go beyond what you would consider basic when doing a whole life uh strategy, an infinite banking strategy, something to get that little bit of extra nickel or dime or oomph out of the policy?
The whole reason Nelson Nash subtitled his book is the title of his book is Becoming Your Own Banker. And the subtitle, I think, is an infinite introduction to the infinite banking concept. Well, that infinite banking concept is really kind of the key, and that's what's been the key phrase. There's people out there, oh yeah, I know infinity banking. Oh, I do this and do that. They do not understand it, right? The way he taught it, the way I follow it, it's a two-edged sword. It's infinite, which means you can do a whole bunch of things with it, which means there's all kinds of fun things you do, but it's also for people to have a hard time to making a decision, it can be daunting. There's so many different ways that you can apply it. And that really is, and I believe he even says in his book, I say it too, is that your rate of return is only limited by your imagination. How the policy performs, or what is has more to do with you as an individual and how you act and how you treat the policy than it does on the insurance company. Yes, the insurance company is going to chug along, and that cash value is going to grow steady at a fairly low interest rate. And in the first few years, maybe 10, 15 years, it's going to feel like it's not going anywhere. And that in that time frame is why some people, radio financial entertainers and TV and financial entertainers will say that whole life insurance is a terrible place to put your money. I would possibly agree with them when you have a very myopic point of view. When you look at a broader point of view that your whole life and what you really need from it, there isn't a better place to store it. There isn't a better place to do, right? And then on top of that, being able to use that money to do other things. Let me give you an example. I'm sitting on the second floor of a 2-story office building in downtown Logan, Utah, where I live. I purchased this building and I had a mortgage on it when I first came to Logan a while ago, and my mortgage payment was real close to $2,000 a month, so I needed to keep it rented downstairs. At that time, I just did one tenant upstairs, downstairs, and I was making that mortgage payment religiously. And as everybody knows, early on you don't have any equity, very little. Well, as it got in a little bit and I had some equity, I didn't have access to it. I could go back to them and beg them for a loan against the equity of my property, but the maximum they would have given me would have been 50% of my equity, 50% of what I paid them back, because I had my down payment and then however much of the principal of the payments over 4 or 5 years. But then I learned about this concept. And what I realized is, look, I'm making out this check for $2,000. They cash it and they send me a statement, say this much interest, this much principal. The reality was is I had access to none of that check. Now, yeah, I was building up some principal and maybe I could get a loan for 50% of whatever my equity was. Maybe if I was creditworthy and I had a job, all these different things, right? What I recognize is, look, I'm going to put as much as I can, as fast as I can into policies. And that's what I did. I built up the cash values of the policies till it got to the point where I could take a loan against the policies. Those checks came in a checking account and I walked over to the bank and I paid them off. Now, this building was not paid off. There's a loan against this building, a big loan against this building, but the note holder now is the insurance company, not that bank. But the cool thing is, when I write out that $2,000 check and it goes to the insurance company and they cash it, I have access to essentially $2,000. And if you look at it just over 1 year, wow, I have access to 24K that I didn't have the year before simply by changing who I'm writing my check out to. Right? Instead of XYZ Bank, it went to ABC Insurance Company, and I have access to 2,000, 24,000, but last year I didn't. Well, now that's put me in a position to where I can say, okay, well, I can use that as a down payment on another property. Maybe I can use that to help fund a new business with my kids, or maybe I can use that to do an inventory loan for someone, or go on a trip to Europe. I don't, whatever it is you want to do. Right. So, and that in my mind, okay, so if I look at a cash on cash return on this building, we're looking about 9%. Okay, well, you have the growth inside the policy, but outside now I have created a 9% cash on cash. Well, after 1 year, I have another 24,000. I can go after another property, and let's say I can get a 5% cash on cash. So now I have that. So I have the policy, this building, that property, and then the next year, next year, next year. So then I start looking at it and say, well, what's really the rate of return on my money? It can become really large for the fact that I'm using it over and over again, right? Because I put that money in, but then I take a loan against it for something else, put money back in for what? And each time I'm upping the rate of return. That's why I tell people very confidently that there is no investment on the planet that is better than controlling the banking function. And what I mean by that is that you can bring the best investment to me, and all I'm going to show you is say, look, this is the infinite banking concept. That's the way we're going to do this. And we're going to look at how you finance that investment, and we're going to make that investment better, just because we're controlling the financing arm of it. And then you start saying, well, God, the world is my oyster. I can give a huge rate of return.
Cool. Well, I think that's kind of answered my conundrum as of late. Is there any final parting thoughts, words?
Hey, yeah, no, I have, like I said, I published this book. It has a little bit about me and my experience with the concept, and also teaches the concept a little bit better. It's not anything to take away from Nelson Nash's book, but however, to attempt to build on it. In Nelson Nash's book, his two examples of financing things are depreciating assets. I have found that the infinite banking concept used with appreciating assets really takes it to a new level. And I'd be happy to, give this book to anyone for if they'll pay postage. I'll send it to them as a gift for listening to the podcast. And we'll put that link in the show notes where you can just go there and put it in, and I'll send it to you for the shipping cost. You'll pay the postage, I'll pay for the book.
Cool. Sounds good, guys.
There's a picture of you. There's a picture of you, Scott, in there, so maybe you should have it.
All right. I need to pick it up. I don't think I've read it cover to cover yet. But we will put it in the show notes down below. So thanks for tuning in, guys. We always appreciate you. If you like the show, make sure to subscribe and leave us a 5-star review. It really helps us out. If you want to connect with Jason or I, again, you got the links down below, or you can hit us up on social media. Last, remember that mastering your millions all starts with your mind and your team. Make sure they are the best. We will catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.